In this video, we're going to be performing a deep dive on Becton Dickinson and Company's dividend safety. To begin, let's talk about Becton Dickinson's business model. Becton Dickinson is a global leader in the medical supply industry. The company was founded in 1897 and has nearly 50,000 employees across 190 countries. Becton Dickinson trades with a market capitalization of $66 billion, with annual revenues of more than $17 billion. Becton Dickinson is a well-known dividend stock because of its compelling track record of dividend growth, with 47 years of consecutive dividend increases. Becton Dickinson is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. In fact, Becton Dickinson is just 3 years from becoming a member of the Dividend Kings, a group of even more exclusive stocks with 50-plus years of dividend increases. Looking ahead, investors interested in owning shares of Becton Dickinson will likely want to know the safety of future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Becton Dickinson's dividend safety in the context of the company's current earnings. When Becton Dickinson announced its fourth quarter of fiscal 2018 financial results on November 6th of last year, the company reported that it generated earnings per share of $11.01 for the year. For context, Becton Dickinson paid $3 of common share dividends during the same time period for a dividend payout ratio of 27%. For fiscal 2019, Becton Dickinson expects to pay out $3.08 of common share dividends while earning $12.10 per share for a dividend payout ratio of 25%. Using earnings for either the prior or current year, Becton Dickinson's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Becton Dickinson's current dividend payment to its free cash flow. Through the first 3 months of fiscal 2019, Becton Dickinson generated $2.87 billion of cash from operating activities and spent $895 million on capital expenditures for free cash flow of $1.98 billion. The company distributed $927 million of common share dividends during the same time period for a free cash flow dividend payout ratio of 47%. Using free cash flow, our conclusion is the same as when we used earnings to measure Becton Dickinson's dividend safety. The company's dividend appears safe for the foreseeable future. Although we note that its payout ratio using free cash flow is significantly higher than the earnings per share equivalent, companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Becton Dickinson's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Becton Dickinson's performance during this time period is shown here. Becton Dickinson's earnings per share increased by 16% in 2008 and by 11% in 2009. Not many other companies were able to produce this type of growth during the depths of the last recession. More importantly, the company's earnings continued to cover its dividend and Becton Dickinson continued its multi-decade streak of consecutive dividend increases. Accordingly, we have no concern about Becton Dickinson's ability to pay rising dividends during future economic downturns. The last angle we will use to assess Becton Dickinson's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. Through the first 3 months of fiscal 2019, Becton Dickinson generated $171 million of interest expense and had $21.1 billion of debt outstanding for an annualized weighted average interest rate of 3.2%. The following image shows how changes to Becton Dickinson's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Becton Dickinson's weighted average interest rate would need to rise well above the 9% level before its dividend would no longer be covered by free cash flow. While we generally prefer companies to have a larger margin of safety for this metric, we believe that Becton Dickinson's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Becton Dickinson's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.